Thank you, Dr. Reedy. My name is Shannon Smith. I'm an institutional salesperson at Ariga USA, which is a boutique investment bank specializing in the structured credit sector. So that's all of your CMBS, RMBS, multifamily, and then whole loans as well. And I'm also an alumnus of USD, celebrating my silver reunion this year. Where are you? I have the wonderful pleasure of introducing Dr. Norm Miller. Norm is VP of Analytics of the CoStar Group, as well as a distinguished research professor at USD. Norm is editor of the newly founded Journal of Sustainable Real Estate, and he received his PhD from The Ohio State University. Dr. Miller has written many academic and trade articles and books, ranging in topics from housing, brokerage, mortgage risk, and valuation. Norm is part of the research committees of the Pension Real Estate Association, the Urban Land Institute, and the International Council of Shopping Centers. Thank you very much, Norm, for sharing your wisdom and experience with USD and the Burnham-Moores Center students as they prepare for careers in this great industry. Dr. Norm Miller, Over the Horizon, an expert's view on the retail, office, multifamily, and industrial sector.
Thank you. Thank you, Shannon. And it's lovely when technology works. I think our students there have high EQs from what I can tell. I was very impressed. By the way, walking here, I noticed there's a mental health conference going on. I bumped into somebody. They said that 1 out of 3 Americans has mental problems of some kind. So you know what that means. If you look to your left and you look to your right and they seem okay. So what I'd like to do is mention right up front that the slides that I'm going to show you are available plus twice as many as I have time to go through today at the Burnham-Moores Center for Real Estate website, which is on the back of your program at the bottom. It's usdrealestate.com. So if you want to download the slides, they're in PDF, not only what I'll show you now, but several more that I don't have time to cover. I apologize in advance that we're going to go through them pretty quickly, but I'll try to point out some highlights. So let me start by telling you right up front what I believe, kind of summarize my conclusions, and it does echo some of the points raised in the previous panels. Mark Reedy mentioned before that housing usually leads us into a recession and out of a recession. I think it's a little different this time. That's traditionally been the case. Housing certainly let us in, but I happen to believe that commercial is going to beat housing on the way out because of the delays in the foreclosures, the first-time home buyer tax credits, the robo-signing issues. So housing's actually taking much longer than normal, and as a result of that, we might see that the commercial real estate market actually leads us out slightly before housing. But we have a lot of dispersion out there in terms of prices that I'm going to show you a few charts, and averages don't tell you a whole lot right now. We had our panel on capital talking about the fact that trophy and troubled properties are in high appeal right now. We got this barbell thing going on. And so an average or an index doesn't mean a whole lot. It's like somebody walking with 1 foot on a bed of coals and 1 foot on a bed of ice. And on average, you know, they're comfortable, but it doesn't really reflect what's going on in the marketplace. It's the same thing right now. You're never in your lifetime probably going to see another market like this, where I can show you trends going in the opposite directions depending on which segment of the market you're focused on right now. Secondly, future commercial real estate values are going to be dependent on a race between higher interest rates, which I believe are going to happen, and increasing rents. So we have this race that's going to go on. Interest rates will go up, that's going to drive up residual cap rates, that'll drive down values, but rents will be going up, which will drive up values. And so this is the race to watch over the next several years. In about 2 to 3 years, I believe that we're going to see rent spikes in the office, industrial, and retail markets, even sooner than that in the multifamily property market. Having said that, San Diego does lag a little bit behind the national trends that I'm going to show you. And last, the best time to buy high-quality commercial real estate was 2008 and 2009. Aren't you glad I told you that? If you were buying troubled property, distressed property, in 2008 and 2009, you did great. And one of your biggest problems right now is managing the expectations of your partners, because you're not going to do as good on the deals that you do now as you did in 2008. But there's still 2 to 3 years of distress opportunities out there left for those that can reposition, recapitalize, or wait it out. And I was talking to Doug Wilson yesterday, and the FDIC today is not your father's FDIC from the 1990s. This is not somebody that's going to put a tsunami of distress out there. They are slowly putting it out there, and so we have 2 or 3 years left on that. One scary thing to comment on the capital markets group, we see these lower cap rates for these high trophy properties. What would scare me is when I hear about hedge funds starting to buy more property, especially if they have a 2 and 20 structure. I don't see that they care that much about the price they pay. That would scare me a little bit, but I've only seen a little bit of that so far. So what should you do if you believe me? Well, tenants, despite the accounting disclosure problems, tenants should enter into leases that are as long-term as possible. 15 years with an option to renew would not be crazy. So tenant reps, don't tell the landlords that's what I said. If you're landlords, I would never try to get anything beyond 2 or 3 years from now. Don't tell the tenant reps what I said. Because if you can get your leases expiring before the new supply comes online, and we're just not building anything right now, you're going to have some great opportunities for rental increases in 2 to 3 years. Brokers, we have this opportunity where there's a big discount for lease-up risk right now. I'm going to show you that in a minute in some of my graphs. But if I can match up some empty buildings with investors and tenants and figure out a way that they can share in that residual upside, give tenants a little bit of share if they're a big enough tenant, you could arbitrage this opportunity right now. And developers right now, unfortunately, we still have prices below construction cost in most markets, so build-to-suits are what makes the most sense. There are some upgrading possibilities for LEED and Energy Star buildings. I know there's a lot of cynics out there, but the GSA cannot enter into a building lease unless it is Energy Star labeled from now on. And so if you're just a little bit below that and you have the opportunity to upgrade, and you're in those markets where the GSA is looking, and I know they're looking because they contact me a lot on how to screen through the data quickly and find properties where they say they just can't find them. There's definitely an opportunity there, as well as for other agencies and tenants. So even though I know there's a lot of green cynics out there, I do believe that this upgrading opportunity exists out there. So let me get back to this race between interest rates and rents. So where do you think interest rates are heading? Well, let me give you some theory first. Theory tells us that long-term treasury bonds, and I use the 10-year as kind of my bellwether, should be approximately equal to our real risk-free growth rates plus some expected inflation. So if you believe the most recent budget office forecast, I think they were about 3.5% on the GDP growth, and you add some inflation number to that, 2% if you want to be conservative, you would be at 5.5%. If you say, well, with the oil prices going up and other problems, maybe we're going to be at 2.5% growth rate, add 2% to that, we're at 4.5%. So the point is we're about 100 basis points over with this theory what we're actually observing, because right now they're about 3.5, I think, for the 10 years. Is that about right? So, so what's going to happen when QE2 eases off, quantitative easing? They stop buying our treasuries. The Chinese have already slowed down buying our treasuries. So beginning in June of this year, as they ease off, and not necessarily before that, I would expect interest rates to move towards, pick your scenario, but certainly 50 to 100 basis point increase in 10 years would not surprise me at all. And also it means you should be a little careful pricing off of treasuries. Keep in mind that the long-term treasuries, if you go back 50 years, do you know what they average? The 10-year bonds average 6.2% if you go back to 1953. So, you know, which way are they likely to go? This arbitrage opportunity that I just mentioned, this is a phenomenal opportunity. It's a big spread, and I've been trying to monitor it. But what I have in this graph here on the blue line, and I'm not going to try to use the pointer because I can't go both ways at the same time. The blue line gives you the price of buildings that are 90% occupied or more, and the red line gives you buildings that are 70% or less occupied. And you see that spread? So there's a lot of lease-up risk price discounting going on right now. Let me give it to you one more way. This is the ratio of the two. The price for the occupied buildings to the less occupied buildings. We're still at 179%. Like I said, 2009 would have been the best time to arbitrage this opportunity if you could find a tenant and say, come into my building, eliminate some of my lease-up risk, and let me give you some of the upside, because that's a huge spread, 93% higher price. Let me give you a little bit of an update on where the prices are headed, and what's interesting in this chart, where the red line is the general real estate. That means property that's generally under 20,000 square feet. That's about 70% of all transactions. And then that blue line are what we call investment grade. It's the larger stuff, it's the investment grade stuff, it's the stuff that these guys that were sitting here were talking about pretty much. And what you notice there is in 2010, the investment grade property increased about 8%. And if you use the upper part of that, the trophy properties in the major cities, we were even higher than that. The TBI index, which MIT puts out based on NACREIF data, that's the big stuff. The average price on that is $30, $40 million at the end of the year. That went up 19% last year. Now, by the way, I haven't published the updated numbers yet. They'll come out in about a week. But January for the investment grade went down 1.1%. But generally, it's still up significantly from where it was a year ago. So that trend means there's a lot of money chasing that trophy property. If you look at the red line, the smaller stuff, you know, the good news is in January we ticked up 0.4%. But that hasn't necessarily found a bottom yet. I can't tell you with confidence that that's necessarily found a bottom. So the smaller properties have continued to fall in price, while the trophy and highly occupied buildings in major cities have gone up in price, both at the same time. And that is a little bit unusual, isn't it? Look at the history and you see that generally they move together. We see even a bigger dispersion if I slice this by price range. So when I slice it up, that big blue line on the top, hopefully you can see I made these graphs big enough. That's the $100 million and up deal. And look how fast those prices have come back. Now they're not back to where they were before, but this is astounding how quickly they've come back, how much money is chasing the large deals, the trophy properties. You look at the $50 to $100 million deals, and that's that yellow line. And then look at the stuff $5 million and below. That's the line at the bottom, that orange line. And you can see that's kind of languishing. So what about distress? That was brought up in the last panel. I'll give you a few statistics on it. And by the way, our volumes are up. About 20% in January, and even more than that December. So our volumes are running 20-30% higher in terms of sales transactions. So in terms of distress, and I confirmed this yesterday with Doug Wilson. He sees the same things. Generally, we're seeing distress tapering down. The worst has been, as a percentage of the market, hospitality, hotels. And next you see multifamily, and then we have office, industrial, retail. But there's still a lot of distress out there, and it's still going to take a couple more years. Let me give it to you one more way. This is an easy way to scan it. As a percentage of the sales, hospitality, there's still a lot. Meanwhile, the rack rates are going up there, and it might be a great time to consider hotels. Then we have multifamily and so forth down the line. We can look at it one more way. We did have a couple bankers up here, at least one or so. What's interesting is if you're too big to fail, your distress is going down. You're already seeing a lower proportion of loans that are in trouble. And if you're under $1 billion in asset size, which is the red line there with the blue squares, maybe you're at a peak now, but it's not heading down yet. So in terms of bank size and distress, it's true the smaller banks still have more problems than larger banks, and the larger banks are finally working that down. Let me show you one more way of looking at distress. The size of the bubble is the size of the dollar distress in that market. And then on the one axis, I know it's a little complicated, it's the percentage of the sales. On the other axis, the vertical, it's the percentage of the total market. But you look out there at Atlanta, and that's kind of the poster child for problems across the board. But we do have a few other markets in California that have some good-sized bubbles. And then look at San Diego, which it took me a little bit of time to spot San Diego because the labels didn't show up. But San Diego's down there at about 12%. So we're on the lower end in this particular market. So as quickly as I can, I'm going to go through each of the major markets and give you a snapshot. Again, these slides are going to be available to you. But let's start with office. And I'm going to give you a national picture and then a California picture. So notice for office who's buying. The blue bars are buying activity and the gray are sellers. So when you see this red line, that's the average. So in terms of net buying, who's the big player here? It's the REITs. The REITs are big net buyers. Why are they big net buyers? Pretty low treasuries, pretty low dividend rates, access to capital. And so as long as they keep this cheap cost of money, and I know they're supposed to be using IRRs and total returns for their cost of money. That's in my textbook, as a matter of fact. But on the other hand, short-term current yields being low makes it a lot easier to do accretive investment. So the REITs are out there buying, and I'm not going to show you the other charts for all the property types, but they all look the same. They all look the same. The REITs are the big net buyers across the board. We also have users in office. And the users mean that basically occupants that normally would be renters have decided it's so cheap that some of them are buying. Now I'm assuming that some of them are going to pull a stunt like CoStar did, buy the building that's empty, do a sale leaseback, and pull out some money, which makes a lot of sense. If you look at private equity, institutional, and private money in 2010, a lot of buyers and a lot of sellers, but net they're confused. Sometimes we use the pension funds as kind of a perverse indicator. When they're buying big time, it's probably time to sell. In terms of our supply, if you look at these across the board for all property types, we are adding so little supply. That dashed line is what we normally add historically. But for every single property type, our supply is actually shrinking right now. We're adding less than the stock that we're losing to fires and natural disasters and eminent domain and just wearing out. And so our stocks are shrinking. So in the office market, we're way below our historical number. And this is true, again, I'm not going to show you all of it, but across the board, we're adding less new supply than we're losing. So one of the leading indicators I look at for the office market nationally and it works locally are corporate profits. And corporate profits are at pre-recession levels. They're setting new records. And the interesting thing is this, when I match it up with employment data, it leads employment by 4 months. Your best leading indicator is about 4 months. So that tells me we should be hiring like crazy right now. And we are not. January, 36,000, anemic. And what really counts here, by the way, is employment more than unemployment. In multifamily, unemployment matters, but we have to be careful with those figures because unemployment might just mean that you ran out of benefits when it goes down. It doesn't necessarily mean that people aren't looking for jobs. So positive employment, every net new job matters. So we should be hiring in the range of 250,000 people right now per month. And I expect that we will. But it's certainly been a little bit more of a lag than expected. Here's what we see historically between job growth and absorption. So the point is corporate profits lead jobs by about 4 months normally. Jobs lead absorption by a few months. Absorption leads rents. And all the signals are lined up in the right direction. We should be hiring a lot more in the next couple months than we have been historically. And notice that these blue bars, the last 3 quarters for the U.S. as a whole, we saw positive net absorption. So for the United States, we're actually in a positive net absorption market. It's a great leading indicator of rents. Unfortunately, if we look at California, we only saw positive absorption the last quarter of 2010. So we are lagging the national economy in terms of employment and office absorption. And this is true across the board in most of our markets, although industrial is doing a little bit better. So this yellow bar for California shows you net absorption for office. Here's our rental rates in California for office. If you look at the top red line, direct rental rate, it looks like we're still in a soft market, but one of the leading indicators are the sublet rents, which have started to tick up. So we're getting closer to a bottom where asking rents are moving in a positive direction. This doesn't mean that the NOIs are moving in a positive direction. That'll take a while, a year or two, because we're still coming off of leases that were signed 3-5 years ago, and of course they're at lower numbers, even if the rents are starting to tick up in some markets. In terms of buyers, what's interesting, it's the usual suspects in terms of institutional players. I did put this up quickly just to notice there's a little bit of foreign interest there on the bottom. Some smart teachers in Korea buying some of our California real estate. Let me switch to industrial. If you notice the yellow bars, and this looks pretty much like the national pattern, we're seeing positive absorption in industrial. And again, this leads rental rates. Rents, still a little bit soft. Can't say that we're at a bottom yet on industrial, but we're certainly getting close to a bottom on industrial. If you look at retail, we've seen modest positive absorption. Now, this is a bit of a surprise market to me. 2 years ago, if you asked me about retail, I wouldn't have expected that market to turn around so quickly. But what we've seen is 2 years ago, we had 175 million square feet that was just vacated, and a lot of that has been reabsorbed. I'm very surprised how quickly some of that troubled retail property has been snapped up or reabsorbed or leased up. But this market's turning around a little bit more quickly than we had anticipated. And here's one of the reasons why. It's a value play in terms of who's out there. You know, you give us a little recession, and anybody with a dollar or general or family in their name seems to be a top leasing tenant out there. But here's one of the surprises to me. I checked on the data 3 times. Goodwill's in the top 5 in terms of tenants expanding in the country over the last 2 years and last year. Now that's incredible. I even saw an ad on TV with Goodwill. Did you ever think that you'd see that? So this is a bit of a surprise. Now this next graph is really complicated because it comes from PPR in Boston, and they think the more complicated it is, the smarter they are. But let me just draw your attention to the bars above the green. So the green are traditional grocery stores that are constructing less than they used to, a lot less new supply. Those black bars there are your Walmarts with grocery, and then you have your Costco's and your Sam's. And the point of this is that we have this new competition. Again, it's a value play. with Costco and Sam's and Walmarts and others competing in the grocery arena. And so it's an interesting local debate topic as well, I'm sure. But if you do go to Costco, the minimum purchase is so big, though, you have to donate your clothes to Goodwill, so it'll keep them in business. One thing I'd like to note there, the per capita numbers on retail, they keep getting higher, not just for the groceries, but for everything. And the retail analysts that I deal with, they always tell me, oh, it's horrible, we have 30% too much retail in the country. We don't. I used to think that as well. We don't. If you really focus, if you're old enough to think about who were the tenants 10 and 20 years ago versus now, we have so many tenants that don't sell anything in the retail centers. Fitness centers to help you get rid of the stuff you get at Costco, and they don't sell anything but hope. And accounting firms and lawyer firms and investment houses and H&R Block and Scott Trade and so forth that don't sell anything. So we really shouldn't use this over time per capita number unless we adjust for this changing tenant mix. One of the things that baffles us is that retail sales are back at pre-recession levels. Now, I know the stock market has done better, and that probably helps the upper-end households a little bit, but the retail sales are really astounding us with how strong they are. So there's a couple reasons for this. One point is it's not sustainable based on current income. We're not making enough money to sustain these kind of sales. So we might see a double dip here. But one of the reasons we're spending so much is because during the recession, the last couple of years, we didn't spend much. So that blue area that I shaded in, that's spending that we postponed from 2 years ago on cars, appliances, and so forth, and we're spending it now. Another possible reason, this is my own theory, I don't have any proof, it could be this strategic default thing that's going on. The other day on the news, I see this guy from La Jolla, nothing to pick on La Jolla, and he said he was saving $10,000 a month because his house was so far underwater there's no sense paying his property tax bills and his mortgage payments, and he was living there almost 2 years, kind of default homesteading, if there's such a term. And this guy reminds me of somebody in third grade who would flip a coin and say, heads I win, tails you lose. It's like if the home price goes up, I get to keep it, and if it doesn't go up, the lender gets it. Now, don't get me wrong, I'd be more sympathetic if he lost his job. He was still working. I'd still kick him out, but I'd be more sympathetic. But this could be helping to drive some of the retail spending, because what's he doing with that $10,000 a month? He probably went out and bought a car. Probably got a tax credit last year on buying a car. So it probably is helping our retail spending. And the point is, it's probably also going to hurt us a little bit in terms of when the foreclosures do go through. It's probably going to be these default homesteaders won't be spending money. So what's bad for home ownership is good for multifamily, which is what this next chart is. And I see I'm running short on time, so what I think I'll do is I'll mention that there's so little supply in multifamily that we are going to see rental spikes. There's just no question about it. So summary and rational strategies. What would I do? At the low risk end, you can buy these highly occupied properties, get low returns. You can do things that we know are growing, student housing, senior housing, healthcare facilities, they all make sense. You go to moderate risk, I think it's a good time to buy hotels. Distressed office real estate, especially if you can find a tenant that'll share on the upside with you. Distressed multifamily continues to make sense as long as there's no HOA hanging around that's going to plague you. Mezz equity, because now we're, of course, using lower loan to values on everything, makes sense. Upgrading properties for the GSA, I know nobody believes me on that yet, but I think that is a good play. Data storage facilities, because in the next 10 years we're going to have 3 times the data storage requirements in the United States that we do right now. And then there's a few other wild ideas. There's electric plugs nobody uses in front of the LEED Gold buildings. 3 to 5 years from now, there's going to be great demand for that. So I'd try to lock up some parking spots by fitness centers and movie houses and things like that and try to do this 4-fee parking, because 5 years from now, there's going to be a lot of electric cars that wouldn't mind plugging in and putting a few coins in, or no, probably a credit card or something like that. So Shannon, why don't you join me up here, and we'll try to wrap up with some questions and stay close to schedule.
All right, thanks. I know that foreign investors are buying more U.S. commercial real estate. So is that having an impact on prices?
I hear this a lot, that foreign investors are buying in the United States, and they are, but they're pretty much just buying in 6 cities. So name your biggest 6 cities. They're buying in New York and Washington, D.C., and they like Boston, they like L.A., they like San Francisco, a little bit Chicago, and that's pretty much it. So they are affecting the market, but only the top-end trophy stuff, and really they don't have an effect on 90% of the markets out there, but they do an effect on the big ones.
And I have a lot of REIT clients, and they're always telling me about their purchases. So do you see that continuing this year and perhaps a little next year?
As long as our treasury rates stay low and they can get by with these really low dividend yields, I see REITs going out. They should be putting out IPOs or secondary issues as much as they can, accumulating that capital. They have a lot of dry capital out there. And so I see that lasting at least 6 months. And if I were them, I would definitely put out issues before QE2 backs off and interest rates go up. After interest rates go up, say 100 basis points or more, I think that the REITs will have to slow down. Their access to capital will start to slow down. But right now they're in a sweet spot, and they know it. Yeah.
CMBS money coming back. We had some earlier speakers that were talking about the same thing. Why do you think this has been so quick?
It's an interesting question, and one of the things that baffles me are the rating agencies. Rating agencies are a little bit like roaches after a nuclear war. I mean, they have the uncanny ability to survive. No matter what, they have the ability to survive. And they should have changed their models by now, and I understand that they have, but they really came through this whole thing unscathed. But they're back in business, and it looks like, and I wouldn't have predicted this, how many people would have thought we were going to put out $45 billion in new CMBS money in 2011? I would not have predicted the number would have been that high, because when you graph it, I mean, there was $11 billion last year and almost nothing before that. So it's a surprise to me how quickly the CMBS market is coming back, but it is. And we're looking at $45 billion. And so one difference is, of course, it's lower loan to value. It's not the old high loan to value. So that'll last for a while until the lenders that remember what happened in the last couple of years no longer are lenders, and someday we'll have a new crop. For a while, the loan to values will be more conservative, but it is coming back fast.
And finally, switching over to the housing market, will the pending foreclosure glut significantly affect home prices? Double dip.
Well, we did have Mr. Williams this morning say that he thought home prices were going to be a little bit soft. I think the interesting thing about foreclosures is that 80% of the foreclosures are in 20% of the geographies. They're going to affect our index numbers. They're going to affect Case-Shiller. Now, having said that, that means that 80% of the submarkets really aren't going to be severely impacted by it. But the Case-Shiller numbers are still going to go down because of the distressed real estate on the market. So don't pay a whole lot of attention to the index numbers, but yes, they will impact us this year. So I see the home prices as being flat or slightly down because of that. But at the same time, in most of the markets that we live in, it's going to be very modest impact, and it doesn't mean that your submarket's impacted. So yeah, it's going to affect the numbers. The media is going to play up big on it, but it doesn't mean that it's affecting your submarket.
Except, of course, if you're in Riverside County like I have properties.
There are a few places where those 80% are focused. That's true.
Thank you so much, Norm. We really don't have time to open it up, but very informative. Thank you again.
Thank you.
And if I could just... If I could just take a minute too, I am also on USD's National Alumni Board of Directors, and as such, we're constantly looking at ways to engage alumni while helping students. So I'd like to thank all those alumni that are here in attendance who have offered internships and especially hired the quality USD students graduating from our top 25 business school and the BMC. This is a power group here today, and there are many students who would welcome an internship opportunity. I hope you will take the chance to introduce yourselves to them and meet them, because they could be your next star producer or even help you acquire, through their research, those next properties. So I'd like to call up Dan Phelan next. Thank you again.